All right, guys. Hey, I'm sitting here with Jason Woods at Community Mortgage. Just kind of want to give you a walkthrough of what to expect when you're a first-time home buyer or looking to buy a home. One of the first things to do is get pre-approved, and I'm going to send you to a mortgage lender. So Jason just kind of walk through about what the process is and what to expect. So
the process is, once we pull credit, we're going to review credit, look at the income, assets, and make sure that person can qualify based on what's out there in their credit, what kind of income they make, what kind of job they have. Are they W-2, self-employed, commission type income, or anything like that? So once we break it down and figure out what their debt is, figure out what their debt ratio is, what their credit score is, then we're going to tell them exactly what they're going to qualify for.
Okay. Now, when they qualify, that's how you determine how much of the mortgage they can afford. What are the different types of mortgages out there? As far as, like, you got FHA, conventional, VA.
Right. Yeah, FHA is usually your first-time home buyers kind of thing that people usually take, only because it's the minimum down payment of 3.5%. But there's also multiple times that people come back and they continue to use FHA because of that low down payment.
Right.
There's conventional that has 3% down payment. VA is 100%. There's also USDA, which is a rural loan, and it also is 100%.
Okay. So what is if somebody's looking to get a loan right now, what kind of range are they looking at for his rate?
Oh, then that depends.
Yeah.
That's kind of, it depends on credit.
Okay.
To credit, what your loan amount, what your loan to value is, and so forth. But anywhere on FHA these days, I've seen them 3.5 to 3.75.
Okay.
We've broke that sub 4 area here lately, and VA is about the same. Conventional is always going to be a little bit higher, based on Fannie Mae rates, but those are probably a little higher than that.
Okay.
Rates change daily.
Now, what is the difference between being pre-qualified versus pre-approved?
That's a good one. A lot of people, whenever they get a letter saying that they've been pre-qualified is whenever I pull credit and I only look at their credit, what income they put on their application based on when they apply online, in person, whatever income they tell me, I go off of that information only. And then I solely look at that, look at their debt, figure out what their debt ratio is, and then say, hey, this is what you qualify on based on the income you have provided. That's what we do not do. What we do is an actual pre-approval. Once we pull credit, we ask for actual documents. We like to see that stuff. We tell people all the time, if you'd like to get a jump start on your pre-approval to make sure what you can get qualified for, so we don't tell you something wrong.
Right.
We look at income, we look at assets, tax returns. There's so many things that we have to look at first to get an actual answer, because there's so many different ways people get paid. Commission is different than W-2, regular just hourly wage versus salary. They may have overtime. If they haven't been on the job for 2 years, we may not be able to use that income. So it just depends. We want to make sure that we look at all of that income and their bank statements and tax returns so we can give you an accurate pre-approval. Okay. So it's the difference of looking at their documents first versus not.
So if somebody is getting their documents prepared and they need the, bank statements, how far back are you guys looking? Do you just need 2 weeks, a month?
Normally 60 days.
60 days. Okay.
30 days of pay stubs, 2 years of tax returns.
Okay.
Copy of your driver's license. That's usually what starts it.
Okay. Good to know. All right. So on the different kinds of loans, if somebody is military, they're relocating, and they're trying to use a VA loan and they don't know much about it, and they come to your office, what's the process there? Are they looking at the same kind of documentation, or how do you guys go about that process?
The only different documentation on a VA loan is we need their DD-214, which that's their separation papers, and that allows us to get their certificate of eligibility, which says that they're eligible for a VA loan and what they're actually eligible for. Okay.
Now with the VA loan, you're not using a down payment, right? So what are some of the differences the VA?
Yeah, I mean, essentially a VA loan is 100% loan. That doesn't mean that the veteran can't put money down.
Right.
With VA, you have a funding fee. Funding fee is where the VA charges the veteran a fee to get that 100% loan, and it's based on the first time use or subsequent use. So it just depends on if they put money down, that funding fee can go lower based on if they've had subsequent uses or their first time use. If they go 100%, it's normally about 2.15%.
Okay.
Their second time use, third time use, whatever, is 3.3%.
Okay. Now, conventional versus FHA, like why would somebody choose one over the other? What situations would?
Good question. There's many reasons. Mainly because FHA is the minimum down payment of 3.5% versus the normal 5% down. There is a 3% conventional mortgage, which is, there's two different ones. There's a first-time home buyer and then there's a normal one.
Okay.
You know, it just depends on, it's income driven on the first-time home buyer when it's area driven and things like that. So it just depends on if we can get that person qualified for the 3% mortgage on a conventional. If that doesn't work, we'll normally switch them over to an FHA.
Okay.
But the difference on FHA and conventional is mortgage insurance. Your mortgage insurance is a set amount on FHA, and it's for the life of the loan, unfortunately. And then on conventional, your mortgage insurance it's really set on how well or low your credit score is. Obviously, the higher your credit score, the lower the mortgage insurance. The lower your score, the higher the mortgage insurance. So that's what can set the differences apart.
Okay. Now, what? There are different kinds of loans as far as like if you have a parent, you know, kind of like one we just finished. If you're needing say siblings to buy a house for an elderly adult, as the baby boomers are kind of getting older and trying to move into homes out of apartments or vice versa, what are some different options for them there?
All right, two options. As you said, we just closed one, and on FHA, there's one where it doesn't have to be a sibling. It could be a family member, So if someone can't qualify for the loan themselves, they can have a son, a mom, a dad, a grandparent, or somebody like that to go on the loan with them.
Okay.
And whoever that co-borrower is that's helping the borrower on the loan, it's just an FHA non-occupying co-borrower.
Right.
They're basically allowing them to use their credit and their income to help the borrower qualify. On conventional loans, what we just finished, the guy that just came in, he had started out with a Fannie Mae loan, which allows a son or daughter or whatever buy a house for an elderly parent as a primary residence. Normally what would happen is if the borrower can't qualify on their own and you have to buy the house for somebody else, that's called an investment loan. That's going to be 15-20% down or more. But Fannie Mae realizes that, hey, sometimes that can't happen for an elderly person. Allows their sons, daughters, whoever, to buy the house for them. 5% minimum as a primary resident. You get the primary resident rate versus an investment loan rate, which helps out tremendously. So.
Okay. And guys, there are all kinds of different loans, and there's a whole lot more information we could go into detail here. If you have any questions, reach out to me or Jason. The last thing I want to get your view on is the technology and the markets are always changing, and you can do a lot of stuff online now. So why would somebody pick you here locally in town versus getting on one of the online lenders and going about it that way?
Multiple reasons as far as, us being local. We've been here for 35 plus years, but most of the time people go online is for convenience. We all have online applications that we can do and so forth, but I think it's just out of convenience that people go online and do that because they think, hey, it's going to be quick, I'm going to do it on my phone and I'm going to be called. But the thing is, they can't see me, they can't see you. They're only going to call an 800 number. They may or may not get the same person. And that just depends on what they want. What kind of level of service are they expecting to have from the first day we talk till the day we close? What is it that they want? Are they wanting that? Are they okay with online talking to a different person all the time, or do they want to sit down face to face? Right. So.
All right, good information. Hey guys, if they want to get in touch with you, how would they reach you?
Best way is to call me on my cell phone, 901-246-0256.
All right. Thanks guys. Jason, thanks.
Appreciate you, Tristan.